Like you, I work for a living. I will explain an effective investing method that anyone can follow. Think back to the last time you really wanted a high-end gadget or a new pair of sneakers. You've been watching the price for weeks at $200. Suddenly, you get a Saturday morning email. Flash sale, 40% off. What do? You rush to the mall and you feel like a genius, buying that $200 item for $120. You brag about the deal you scored. But here's the thing. When that exact same scenario happens in the stock market, when a great company trading at $200 drops to $120, most people don't run toward it. They panic. They sell. Does that sound familiar? Because that's literally most of us when we start out. Hi, I'm Mr. Bill Money. I started my career with no clue about investing, often buying at the peak of hype and watching my portfolio turn red. If that's you, today we are fixing it with a concept called value investing. If this helps you out, hit subscribe. Why do we behave this way? We've been conditioned to believe you get what you pay for. In the real world, a more expensive car is usually better. So beginners assume if a stock price is going up, the value is going up. That is a massive mistake. Here's what most people don't realize. The stock market is the only store in the world where the customers run out the door when items go on sale. We need to distinguish between two things. Price is what you pay, value is what you get. Value investing is calculating what a business is actually worth, independent of its ticker price. Legendary investor Benjamin Graham said the market is like a manic depressive neighbor. One day he excitedly offers to sell you his house for $500,000. The next day he's panicked and offers it for $300,000. The house hasn't changed. The roof and plumbing are the same. Let's get into the math, because this is where the magic happens. It's called the margin of safety. Imagine building a bridge for 10,000-pound trucks. Do you build it to hold exactly 10,000 pounds? No. You build it to hold 30,000. That extra capacity is your margin of safety in case your calculations are wrong. In investing, it looks like this. Suppose you analyze company ABC. Based on their cash flow and lack of debt, you determine the intrinsic value is $100 per share. A novice says, "Great, it's worth $100, I'll buy it at $100. Stop. A value investor waits. What if your math is off? What if a competitor appears? If you buy at fair value and things go wrong, you lose money. Instead, you wait for the market to have a mood swing and drop the price to $70. Now look at the deal. Intrinsic value, $100. Price paid, $70. Your margin of safety is $30. Even if you were wrong and the company is only worth $85, you still made a profit. The wealthy don't bet on being right. They bet on not being devastated if they're wrong. If this makes sense, why doesn't everyone do it? Because our brains hate it. When a stock is mooning, think AI hype or crypto crazes, everyone is talking about it. Your brain sees the crowd making money and releases dopamine. It feels safe to be in the herd. Value investing is lonely. You often have to buy when everyone else is terrified. Psychologically, humans are hardwired to avoid social pain. Buying what everyone else is selling triggers a physical stress response. You aren't fighting the market. You are fighting your own biology. Now you might be thinking, Mr. Bill Money isn't waiting for a price drop, just timing the market? Here's the distinction. Timing the market is guessing when price will move. Value investing is knowing what you are willing to pay. Think of it like a grocery list. If steak is suddenly $50 a pound, you buy chicken instead. You aren't timing the grocery store. You are simply refusing to pay a price that doesn't offer value. Stop treating the market like a casino. If you want real results, here is your immediate action plan. Stop looking at tickers, start looking at businesses. Don't look at the chart, look at the balance sheet. Does the company have more cash than debt? Are profits growing? Create a buy zone. Pick 3 solid companies you use daily. Determine their fair price based on earnings, then set price alerts on your phone for 20% below that. That is your value zone. Wait for the alert. The 5-year test. Before clicking buy, ask, if the market closed tomorrow for 5 years, would I be comfortable owning this? If no, you're gambling, not investing. Look, I know get-rich-quick trends are exciting, but hoping for a meme stock pop isn't a strategy. It's a prayer. Value investing is about building a financial fortress. Have the patience to wait for the right pitch and the courage to swing when everyone else is striking out. Be the person who buys the shoes when they're 40% off, not when they are double the price just because there's a line outside. Go out there, find your margin of safety, and I'll see you in the next video. Oh, one final thing. If you come this far and like this video,